MACD refers to moving average convergence and divergence. This is a trend-following indicator which is useful in helping traders to identify whether a new trend is bullish or bearish in nature. Do recall the earlier section on moving averages? The MACD is essentially an improved version of moving averages, since it helps us to derive a new relationship between price through the movements within the price's moving average. As you can see, this indicator typically consists of a histogram and two moving lines, the MACD line and the signal line. The crossover of the two lines gives us signals that are quite similar to when crossovers happen when you're analyzing moving averages. Let's have a quick lesson on the components of the MACD indicator. There are three main components that we want to understand in the MACD indicator, and here's how you calculate each one. The MACD line can be calculated by finding the difference between the price's 12-period EMA and 26-period EMA. The signal line can be calculated by running a 9-period EMA on the MACD line. The histogram is then calculated by deducting the signal line value from the MACD line value. This shows that each component of the MACD is intricately connected to each other. When prices are rising, the histogram will inflate and show a positive bar chart value, which is then shown as a green bar on your trading platform. This is because the speed of price movement will accelerate. Conversely, with falling prices, the speed of price movement decelerates, thereby causing the histogram to deflate as a result. This results in a negative bar chart value, which is then shown as a red bar on your trading platform. When using the MACD indicator on your charts, you can easily change the settings to suit your trading strategy. Here are a few of the fields you can adjust by yourself. Fast length controls the number of time periods used to calculate the faster moving average. This is the shorter term EMA, and traders will usually pick the default value of 12. Slow length controls the number of time periods used to calculate the slower moving average. This is the longer term EMA, and traders will usually pick the default value of 26. Source determines what data from each bar will be used in calculations. By default, traders will choose to use the close price from each bar. Signal smoothing, the time period for the EMA of the MACD line, otherwise known as the signal line. By default, traders will use the default, which is 9 days. Although it's not necessary for you to understand in great depth how to calculate all these values, it will help to know how each value is derived so that you can adjust the settings for your MACD indicator if needed. It's important to remember that the MACD indicator is a trend-following indicator. In other words, it means the indicator works well in trending markets, but is not as useful in range-bound markets. Typically, you can use the MACD indicator as a trading strategy by analyzing zero-line crossovers, signal line crossovers, and divergence. The main focus you should have while employing this strategy is when the MACD line crosses zero, which signals to you when you should buy or sell. When the MACD line crosses the zero line from below, i.e. from bottom to top, it is possible that a new uptrend is emerging. Therefore, you should consider taking a long position. Conversely, when the MACD line crosses the zero line from above, i.e. from top to bottom, it's possible that a new downtrend is emerging. Thus, you should consider taking a short position. In other words, the MACD indicator would give you a signal as to when a trend is starting in a particular direction. Knowing this, you can then place your trades appropriately in order to make profit by riding the trend. You may choose to remove the histogram and signal line in order to have a clearer view of the MACD line, which can be done in the Settings tab. You can also add in a horizontal line so you can visualize the crossovers better. As you can see, there are a total of 4 crossovers which you could have possibly used as signals to enter the market. However, as we'll see in the next picture, the MACD can give false signals to go short and then long, one after the other. The MACD can give false signals in a market that's currently not trending. Hence, you should always be aware of your own risk management strategies while using the MACD. In this strategy, traders would have to focus on the 2 lines in the MACD indicator to note when the 2 lines cross each other. The good thing about this strategy, as compared to the zero-line crossover strategy, is that it can preempt a price move slightly faster. When the MACD line crosses above the signal line, it's a bullish sign that the market is likely to experience an uptrend soon. When the MACD line crosses below the signal line, it's a bearish sign that the market is likely to experience a downtrend soon. Hence, You should generally look to place your long and short positions accordingly. As you can see in the above picture, the MACD indicator provided us with two opportunities to enter the market. At the first point, we can see that the MACD crossed below the signal line, which indicates a good time to enter with a short position and sell. At the second point, the MACD crossed above the signal line, which indicates a good time to enter with a long position and buy. However, do be mindful of whipsaw trades, which can happen when the two lines cross each other multiple times within the same period of time. To avoid this, you can consider waiting a little longer to ensure that the trend is long-term before entering the trade. This strategy allows us to focus on how the movement of price and MACD differs, and based on the momentum of price action, decide on the likelihood of a reversal in the market. When the price is making new highs but the MACD is not, it can be considered a bearish divergence. This means that momentum has slowed down and it signals an impending downwards reversal. Conversely, when the price is making new lows but the MACD is not, it can be considered a bullish divergence instead. This also implies that momentum has slowed, thus signaling an incoming upward reversal instead. Here's an example of a bullish divergence in action. Do note that the price can continue to rise and fall for much longer than you may expect when a bullish or bearish divergence is occurring. A more logical method of trading divergence would be to use the histogram for trade entry and exit signals as well, since it gives a more unbiased view of the market. Importantly, you'll need to back up the rationale behind your trade before actually entering the market. As with all the indicators we cover here, be sure to use them in a comprehensive trading strategy instead of in isolation, and always conduct proper risk management. This section is over. Make sure to like, subscribe, and turn on the notification bell so you're the first to know when the next video on Bollinger Bands is released.